Welcome back to Chapter 12, Decision Making. This is Learning Objectives 3 and a mini one for number 5 in the appendix. Determine the most profitable use of a constrained resource. So what do we do when we don't have enough to make everything that is of demand? And a note about customer price sensitivity. When a limited resource of some type restricts the company's ability to satisfy demand, the company is said to have a constraint. The theory of constraints, or TOC, maintains that effectively managing a constraint is important to the financial success of an organization. The challenge is deciding how to best utilize the constrained resource to maximize the company's profits. When a constraint exists, a company should select a product mix that maximizes the total contribution margin earned, since fixed costs usually remain unchanged. A company should not necessarily promote these products that have the highest unit contribution margin. Rather, it should promote the units that earn the highest contribution margin in relation to the constrained resource. Let's look at an example. So we have Ensign. It's a company that produces two products, product 1 and product 2. And here is their data. We see that the contribution margin per unit is $24 for product 1 and $15 for product 2. However, product 1 requires 1 minute of processing time, and product 2 requires 0.5 minutes of processing time. Machine A1 is the constrained resource. We're typically using it at capacity 100% of the time, and that is 2,400 minutes per week. And there is an excess of capacity on all of the other machines. Pardon me, there's excess. So the only one for constraint is possibly machine A1. So should Ensign focus its efforts on product 1 or product 2? Let's take a peek on this. All right, so we have product 1 and product 2. Product 1, let's see, product 1 and product 2. Let's shift this over by 1. Okay. And we see that they have a CM, a contribution margin of $24 and $15 respectively. But we have a constrained resource. So our constraint is our, who is this? A1, machine A1. And so how much of the constrained resources did this use? This requires 1 minute per each unit, and this requires 0.5 minutes. So this means that the contribution margin per constraint is 24 divided by 1, and we have $15 divided by 0.5 equals 30. Okay. So that means that in 1 minute of A1 produces $30 worth of product 2, whereas 1 minute of A1 produces $24 of product 1. So therefore, we want to make all that we can of product 2 because it yields a higher amount per constrained resource. So we make all of product 2's demands, and then we go over to product 1 if we want to maximize our constrained resources. All right, let's go back to the slides and go for our next example. All right, so this is our quick check. So feel free to take a screenshot and address yes or no on here and press pause the video, answer yes or no, and then come back and we will answer this together. All right, so we have Colonel Heritage. For the life of me, people, whenever I see colonial, oh, sorry, it's colonial. Oh, okay. So we have colonial heritage. I also cannot ever understand why it's colonel. and I feel like it doesn't spell Colonel, but yes, here we are, Colonial, making reproduction of colonial furniture from select hardwoods. Fascinating, cool. They are only able to supply 2,000 board feet, so we have supply of 2,000. Let's figure out if that is enough to satisfy demand. We have board feet per unit, and we have monthly demand, so let us see here. We have chairs, people, we have tables, we have board feet per unit, we have monthly demands in unit, monthly, maybe monthly demand in units. Okay, 2, boom, 10, boom, 600, boom, 100, boom. So just taking here. All right, so how many board feet per product? Question mark. 2 feet per unit times 600 units equals 1,200 for them, 1,000 for you. And in total, we are going to need 2,200. And that is going to be a solid no. We do not have enough supply to meet our demand. So no, we must do something about this. Let us talk. It's a very boring background of my backup computer. All right, so now that we understand that we have some constraints, the company's supplier of hardwood only able to do 2,000. So what makes to maximize the profits? Well, we gotta make sure we make the most profitable one first, and then the remainder of the second profitable one, we have 2 units. So is it gonna be A, B, C, or D? Consider pausing the video and giving it an attempt. And when you unpause, I will see you in Excel and we will do this one together. Talk to you soon. All right, so let's do this one together. Let's go back to our table and chairs. We are going to have our contribution margin. So that is going to be equal to our 80 minus our 30. Selling price minus variable costs. And for tables is equal to our 400 minus 200, for our contribution margin. Okay, and then we are going to have our board per feet, and we require 2 feet for this one and 10 feet for this one. So we are going to have a contribution margin per constrained resource of 30 for our chairs and 20 for our tables. So people, we're going to say rank, and we're going to rank this one as number 1 because we're making the most contribution margin per constraint resource. So CM per constraint, which is our feet of wood. Feet. Okay. And yeah, so we're going to prioritize our boards here. Why did I say that? Sorry. So that's 80 minus 30. Thank you at home. If you're yelling at me or like, no, that's 30, because this might change the equation. It doesn't. This is still going to be ranked number 1, but you are right. If you're like getting ready to email me, awesome. Awesome. I love that. Not this time, but maybe another time. Okay. Or this is the last video, so we'll see. Okay. So making all of chairs. And then when we exhaust the demand for chairs, going on to our tables. So we have 2,000. This requires 1,200. So we are going to make 600. Make 600 chairs. That is going to leave 2,000 minus 1,200. So that's going to leave 800 feet for tables. So we're going to make 600. We're going to have 800 feet left for tables equals 800 divided by feet per unit divided by 10 for tables. So we're going to make 80 chairs, 600 chairs, 80 tables. And how much are we going to make from all of that? Well, this is going to be 600 times by 50. And this is going to be 200 times by 80. So in total, we are all going to make $46,000 by utilizing our constrained resources effectively. Alrighty, so fabulous, fabulous. I may have skipped ahead through some of the quick checks because I got excited, but you can see for yourself in our quick check that means that in order to maximize profits, pardon me, that it's 600 shares and 80 tables, and I left a little proof on here in case you want to kind of see another way to work through that. I prefer Excel, but here we go. Lovely Ruth and her team left this up here as well. So, all right, quick note. When managing constraints, profits can be increased by effectively managing these constraints. There's always going to be constraints unless you have excess of everything and then really you have underutilized assets. So why do you have constraints? Constraints are kind of a part of doing business, and part of managing effectively is managing those constraints. Again, it means that we're not paying for a bunch of things that we're not using. But in order to do so, that is manage effectively, you will want to focus on managing those bottlenecks and finding ways to increase capacity at the bottlenecks. You might want to improve the process. Can we maybe reduce the amount of waste if we have a supplier constraint? If it's labor constraint, maybe you add an overtime or a third shift. Maybe you hire new workers or require more machines. Maybe you subcontract some production. Maybe you find a way to reduce the number of defective products of units produced and add workers transferred from non-bottleneck departments. So it can get a little bit more complex as well. So what if a firm has more than one constraint? How would they find the right contribution of products to produce? The right combination of products or mix of products can be then used by using a quantitative method called linear programming. You do not need to know how to linear program. You would just need to know that you would use linear programming if you had multiple constraints, and that is the limit of the examinable part for this course. Okay. So what do you need to know? You need to know, how do you manage one constraint? How do you do so effectively? It's contribution margin per constraint, and make the most out of the highest contribution margin per constraint, and then make the rest of the leftover demand. Cool. All right, quick note about Learning Objective 5. Again, this is an appendix. Our appendixes tend to be a bit shorter. This one is absolutely shorter, but it is important to know. So customers generally do have considerable choice in their purchasing decisions. They can purchase your product, a competitor's product, or allocate their spending budget to some other product altogether. The degree of choice should absolutely be taken into account when setting prices. Ideally, one of the ways in which you can consider setting your price, an alternative to cost plus pricing, is known as value-based pricing. Companies that use value-based pricing establish selling prices based on the economic value of the benefits from their product or services provided to customers. One approach to value-based pricing relies on a concept known as economic value to the customer, or EVC. EVC is where a product's economic value to the customer is the price the customer's best available alternative plus the value of what differentiates the product from that alternative. Basically, in short, it's what does the customer feel like it's actually worth? The price that the best available alternative is known as a reference value, whereas the value of what differentiates the product from that best alternative is known as differentiation value. A product's differentiation value can arise in either of two ways. First, a product may differentiate itself by enabling customers to generate more sales and contribution margin than the best available alternative. Second, a product may differentiate itself by enabling customers to realize greater cost savings than the best available alternative. Either way, the customer needs to feel like they're getting something for this in addition to the next best alternative. It's kind of like this. You're at the store. Yes, I'm going to bring up Greek yogurt, people. It just depends how I'm eating. If I'm like all about the creaminess or if I'm all about the 0%. Let us assume that we are about the 0% because then I'm going to be looking for, okay, what has the lowest fat but the highest flavor? Because now I'm not getting creamy flavor. So I want to look at cherries. I want to look at coconut. I want to look at basically how am I getting like a good taste to calorie ratio in anything other than vanilla. Okay, so if I'm doing that and I look and kind of the baseline President's Choice is $7 and it's, they have moderate calories, moderate flavor, like they're kind of just my baseline. They are my reference value. And then I see Oikos or I see, what do I have in the fridge right now? I know the product to see it. It is like luxurious. And I'm like, okay, cool, but you're, $8.99. But your cherry, you have fewer calories, you have less fat, you have more flavor. Your differentiating value is high. It is way higher than that $2 differential. I will load up on that cherry. I will load up on that coconut because I want my nighttime protein snack to be delicious. You may have things in your life where they have a high differentiation value and you're willing to, spend those extra few dollars or hundreds of dollars or thousands of dollars. And you might have those things that don't. And I, as your accounting professor, I really encourage you. Like I'm a big fan of minimal viable product. Those in entrepreneurship, those in like Silicon Valley reading, you might know that as minimal viable product is like, what is the proof of concept that you can get out so you can pitch and raise money? I tend to use it as like, what is my reference value? How can I pay the least amount for a sustained amount of value for most things? And then what am I going to go above and beyond for things that I'm like, damn, this is worth it. This has some differentiation value. If there's anything that I'm going to leave you with in this course, it's one thing. It depends. Is this too expensive? It depends. Is this worth it? It depends. Is this a relevant cost? It depends. It depends on who you are, that is, what is your role? Who is your user? What are they asking you to do? And what are the case facts? What is the situation? In accounting, in business, as accounting is the language of business, we are not memorizing, but we are applying the knowledge. When we are doing budgets, we are doing it to ensure that we have enough of our life, our product, our company wrapped up into the hopes and dreams of our users, our stakeholders, our shareholders, our managers, and that we are saying, hey, this is the best that we can do given the circumstances. Here's our plan to go execute. When we are making decisions to add or drop, we are saying, here is our best information. Here's what's relevant. Here's what's irrelevant. Here's how we suggest you proceed quantitatively. Numbers are business and business are numbers. But not everything is all about the numbers. So I implore you to utilize numbers and know when they're relevant and then know when they're not. Thank you, everybody. I hope you have a really great rest of your semester. It's been my absolute pleasure and honor to work with you. I will see you via the discussion board, and I hope you are well. Take care.